Understanding market cycles is one of those foundations that quietly determines whether you survive long enough to benefit from experience. Because markets do not move randomly in straight lines. They move in phases that reflect human behavior under optimism, fear, denial, and recovery. And if you don't understand which phase you are in, you will consistently apply the wrong behavior at the worst possible time. I learned this lesson not from textbooks, but from living through full cycles. The dot-com boom and collapse. The long bull that followed the 2008 crisis. The recovery, the COVID shock, and the renewed optimism afterward. And what became painfully clear is that most losses are not caused by bad ideas. They are caused by being emotionally positioned for the previous phase, while the market has already moved on. A bull market is not simply a market that goes up. That definition is too shallow to be useful. A true bull phase is characterized by expanding confidence, rising participation, and a gradual lowering of perceived risk. In the early stages of a bull market, skepticism dominates. Prices rise, but participation is cautious. Pullbacks are sharp because people are still afraid. This is where disciplined investors quietly build positions, while narratives are still negative. In the middle stage, confidence grows. Trends become smoother. Bad news is ignored. Dip buying works repeatedly, and this conditions people to believe risk has disappeared. This is where most money is made, and where bad habits quietly form, because success begins to feel like skill rather than environment. The late stage of a bull market is where psychology becomes dangerous. Valuations stretch. Participation broadens to less experienced players. Stories replace analysis. Leverage increases. The market still goes up, sometimes faster than ever, but the character changes. Pullbacks become shallow, not because risk is low, but because fear has been suppressed. This is the phase where people stop asking what could go wrong and start asking how much more can I make. I've seen more long-term damage done in late bull markets than in crashes, because this is where discipline erodes quietly while P&L still looks good. A correction is often misunderstood as a failure of the bull market, when in reality, it is a pressure release. Corrections are typically declines of 10 to 20%, and they serve an important function. They reset expectations, reduce leverage, and remind participants that risk still exists. In healthy markets, corrections feel scary but contained. Structure holds. Leaders pull back but do not collapse. Volume spikes, fear resurfaces briefly, and then the market stabilizes. The mistake most people make during corrections is treating them as either the start of a bear market or as guaranteed buying opportunities. The truth is that corrections are tests. How price behaves during and after them tells you whether the bull market is intact or weakening. A bear market is not just a market that goes down. It is a regime change in behavior. In bear phases, optimism turns into denial, then fear, then capitulation. Rallies fail. Good news is sold. Correlations rise as diversification stops working the way people expect. Time feels compressed. Losses that took months to accumulate during bull markets can happen in weeks. The most dangerous mistake in bear markets is applying bull market logic, buying dips, aggressively holding losers, because it will come back, and assuming previous highs are relevant. Bears punish hope more than anything else. What makes bear markets especially destructive is not just the price decline, but the false hope rallies inside them. Sharp bounces convince people the worst is over. These rallies feel powerful because volatility is high. Many traders get chopped up here, buying strength that fails repeatedly. Bear markets reward patience, smaller size, and a willingness to be underexposed. Survival here is not about prediction. It is about restraint. The traders who survive bear markets are rarely the ones who trade the most, but the ones who understand that not participating is sometimes the correct strategy. One of the most important realizations I had over time is that market cycles are not symmetric. Bull markets tend to last longer and move slower. Bear markets tend to be shorter, but far more violent. Corrections sit in between, and their role depends entirely on context. This asymmetry means your behavior must adapt. The same strategy, the same sizing, and the same expectations cannot be carried across phases without adjustment. Consistent traders are not those who predict cycles perfectly, but those who recognize transitions early enough to change behavior before damage compounds. Another critical lesson is that cycles operate on multiple time frames simultaneously. You can be in a long-term bull market and a short-term correction. You can be in a structural bear market with violent short-term rallies. Confusion arises when traders mix time frames emotionally, investing with a long-term thesis, but reacting to short-term volatility or trading short-term setups while carrying long-term hope. Understanding which cycle matters for your time horizon is essential. The cycle that defines your risk must be the cycle that defines your decisions. Market cycles are ultimately expressions of human psychology at scale. Greed expands slowly. Fear contracts quickly. Denial lingers. Acceptance arrives quietly. These patterns repeat not because people are stupid, but because human behavior under uncertainty is remarkably consistent across generations. Technology changes. Products change. The emotional arc does not. That is why understanding cycles is not about forecasting the next top or bottom. It is about aligning behavior with reality instead of memory. And this is where we need to continue next, because understanding the definitions of bull-bear and correction phases is only the beginning. The real edge comes from knowing how to behave differently in each phase, how to adjust risk expectations and strategy as cycles evolve, how to avoid the most common mistakes people make when transitioning between phases, and how to recognize early signs that the market is shifting before headlines catch up and emotions take control. And that transition from understanding cycles conceptually into learning how to operate intelligently within them is exactly where we go next. As this sentence carries forward into the practical framework for adapting your behavior across market cycles, rather than being dragged through them emotionally and financially. As so many people are, every time the environment changes, and that is where we continue next, by adjusting behavior first and opinions second. Because market cycles do not reward those who think the most, they reward those who adapt the fastest without panicking. In a bull market, the primary danger is not loss, it is complacency. The correct behavior in early and middle bull phases is participation with discipline, staying invested, allowing trends to work, and resisting the urge to overtrade or constantly optimize. This is the phase where adding risk gradually, not aggressively, makes sense, where winners are allowed to run, and where boredom should be interpreted as health rather than as a problem to fix. But as the bull matures, behavior must shift, even if price has not yet confirmed it. Late bull markets demand restraint. Position sizes should stop expanding. Leverage should come down. Risk management should tighten quietly while confidence in the crowd is peaking. The biggest mistake here is confusing a favorable environment with personal brilliance and assuming it will last indefinitely. During corrections, the correct behavior is observation before action. Corrections are information-rich periods, but only if you slow down enough to read them. Instead of rushing to buy or sell, you watch how leaders behave, how volume responds, how quickly fear is absorbed or not. Corrections that resolve constructively show stabilization, higher lows, and selective strength returning. Corrections that fail show persistent selling, expanding volatility, and failed bounces. The mistake most people make is treating every correction as a buying opportunity without waiting for evidence. The correct approach is conditional engagement, smaller size, higher selectivity, and a willingness to be wrong quickly. Corrections are not the time to prove conviction. They are the time to test assumptions gently. In bear markets, behavior must change the most dramatically, and this is where most people fail because they are emotionally anchored to the previous bull. The primary objective in bear phases is capital and psychological preservation, not profit maximization. This means trading less, reducing exposure, raising cash, and accepting that many days or weeks may pass with no action at all. Bear markets punish activity more than inactivity. They reward patience, humility, and the ability to wait for structure to rebuild. Buying dips, aggressively holding losers because of long-term hope, and assuming historical averages will rescue you are behaviors imported from bull markets that bear markets exploit ruthlessly. One of the most powerful habits I developed was redefining success in each phase. In bull markets, success is participation without excess. In corrections, success is clarity without urgency. In bear markets, success is survival without drama. When I aligned my expectations this way, frustration dropped dramatically. I stopped demanding the same outcomes from different environments. The market became something to work with instead of something to argue against. Another critical discipline is time frame alignment. Long-term investors should let long-term cycles define behavior, not short-term noise. Short-term traders must respect short-term cycles without importing long-term hope into losing trades. Confusion arises when cycles are mixed emotionally. A daily correction inside a weekly bull does not require panic. A weekly breakdown inside a long-term bear does not deserve blind optimism. Knowing which cycle governs your risk is how you avoid being pulled apart by conflicting signals. Perhaps the most valuable skill in navigating cycles is recognizing transition periods, because transitions are where damage concentrates. Transitions are uncomfortable because old rules stop working before new ones are obvious. Indicators conflict, volatility rises, confidence drops. This is where most traders try to force clarity and lose money doing it. The correct response to transition is reduction, less size, less frequency, more observation. Transition is not a call to be clever. It is a call to be cautious. When clarity returns, opportunity will be obvious enough that you won't need to chase it. Over time, I noticed that traders who survived multiple cycles were not the best forecasters. They were the best listeners. They paid attention to how price behaved relative to expectations. They noticed when rallies stopped following through or when sell-offs stopped accelerating. They adjusted before headlines changed. They did not wait for certainty, because certainty arrives last after the damage is done. Understanding market cycles ultimately teaches humility. It reminds you that no environment lasts forever, and that your job is not to be permanently bullish or bearish, but to be appropriately positioned for what is not, for what was, or what you wish would return. Cycles do not repeat exactly, but they rhyme closely enough that behavior can be prepared even if outcomes cannot be predicted. That is the practical mastery of market cycles. Not prediction, not bravado, adaptation. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning how to move with markets instead of being dragged by them, and leave a comment sharing which phase you find hardest to handle emotionally. Bull correction or bear, because recognizing where discipline tends to break is the first step toward building a response that holds when the cycle inevitably turns again.